one thing that strikes me is that even for professional investors, economists, forecasters, it's really, really, really hard to forecast and time a recession correctly. So I think that's something all investors should really keep in mind is that even some of the best Wall Street strategists, economists, if you keep hearing about a recession, sure, maybe we'll fall into a recession in the first half of this year, but maybe we won't. No one got 2022 right. So I think it's important to take all of these forecasts with a grain of salt because it's really hard to time the market and kind of position perfectly for these things.
Thrilled to have on the podcast today leads writer for the Wall Street Journal, CNBC correspondent, award-winning journalist, Gunjan Banerji. Welcome, Gunjan.
Thank you for having me, Andrew. I'm really excited.
Excited, too, because I have wanted to pick someone smart's brain about the markets and the economy of 2023 ever since the year got started, which I guess isn't that long. But I made a series of predictions at the beginning of the year, and one of them was that I thought that there would be an economic recession in 2023. And I based that on the fact that I'd had a bunch of conversations with various investors and CEOs. And let me say that their mood could best be described as lousy or something along those lines. And I put that into my predictions in part because I wanted to send a message to people. It's like, look, this might not be the year of mammoth risk-taking. So what do you think of that? And also, what kind of sources of information do you get as someone who works for both the Wall Street Journal and CNBC?
Thanks, Andrew. Well, I just want to start by saying that you are not alone when it comes to feeling or thinking that we are going to enter a recession in 2023. And I feel like even in 2022, so many people were predicting a recession. It kind of even became part of pop culture, right? You had rapper Cardi B weighing in, saying that she thought we were in a downturn, commenting on high inflation. So it's been all about when are we going to enter a recession? And Wall Street is expecting one in 2023. Like for the investors I've been speaking with, it's kind of the base case. Like to a lot of people, it's not if, it's when does it happen? To be honest, I wonder if we're too pessimistic because when I look at the economic data, the Friday jobs report, unemployment hit a 50-year low. Like if you want a job, it's still easier to find one than it has been at a lot of different times over the past decade. So it makes me wonder, like, why are we so pessimistic about the economy? Are people too gloomy about the economy going into 2023?
So you talked about the scuttlebutt you're getting from Wall Street investors. Do folks talk to you both on the record and off the record? Do you just have casual conversations and see what's going on, and they'll say, hey, between you and me, and then they'll download stuff to you?
Yeah, I have a range of conversations with investors, right? A lot of these are on the record. I'm quoting them in my coverage. And then I'm always looking to chat with people off the record, on background, just to get a sense of where their head's at, what they're seeing out there in the market, when they're putting on trades, when they're investing. And those types of conversations are super helpful. I'm also looking at, all this economic data that comes out, what the big banks are saying. So there's like a deluge of information out there to kind of parse through on any given day.
Fascinating. And so you kind of choose what to share, what to write about, and then other things you keep to yourself until it becomes story worthy. So some of the big stories in the markets over this last few months, really, there's been a massive pullback in the tech sector, which had enjoyed this kind of sense of both growth and froth and safety, I suppose. It's like, can't go wrong if you just buy Amazon, Apple, Netflix, et cetera. And then simultaneously, you had this crash in crypto where the space lost trillions of dollars in value, and everyone is fascinated by the Sam Bankman-Fried story. It's like, like you can't get enough of it, which I get as someone who'd met Sam and know a lot of people that know him. So I will confess to everyone here, I was someone who looked at all the political donations Sam was making and saying, why can't we get some of that? But I never actually succeeded. So I was among, which now I guess is like a pretty good look. But you had this implosion of crypto, and then this massive pullback in large cap tech companies. First, do you see any spillover from crypto into the other markets? And second, what do you make of the relative collapse in valuation of the big tech companies?
First of all, I don't think there's been so far a ton of spillover from crypto into the stock market, the bond market. And I think that was really interesting because that was a fear I had heard about quite a lot. When I'd be meeting with sources, talking to them, they were like, watch out for, when you see this big deleveraging, you see all this selling in the crypto market, watch out for how it ripples into the stock market. And the good news is it's been relatively insulated.
Interesting.
That being said, it may not be over yet, right? We don't know where
also
crypto
true.
goes from here, right? Like it's still trading near 20,000, well off the peak last year. But there's people that think it's going to zero. There's people that think, hey, this sell-off is actually just beginning. And it's interesting, the tech bubble keeps coming up in my conversations with investors, where a lot of investors do see comparisons with what's happened to mega cap tech, the Facebooks, Netflixes, Googles of the world, and what happened when the dot-com bubble burst in 2000. And what they've been saying is, hey, that took several years to play out, right? We've seen 1 year go by, the FANGs have really been dethroned in the market, but what is next? Do these companies keep selling off? And I think you do have a class of investors that's saying the sell-off is just starting and it's not over just yet in some of the more speculative corners of the market. And even in the safer big technology stocks, I think it's hard to overstate how important these companies are to our society and also investors, where, one of my cousins, the past few years, he got into investing and he bought the FANG stocks. He bought Facebook, Apple, Netflix, Google, and he felt really rich on the way up, right? Like he kind of laughed at me for my index fund investments and was like, I'm up like 70%, I'm up this much. And he's sold out of those stocks now and he's moving to index funds now. And I think you're seeing that in several parts of the market.
Well, let's talk about that a little bit, because one of the things I want to do is provide some kind of practical, actionable guidance for folks. So you've done what most smart people say to do, which, by the way, I also say to do, which is don't try and outsmart everyone. Don't pick individual stocks and think you're a genius, that you're better off just taking a broad swath of stocks in a bucket through an index fund. I personally would recommend an ETF. Like you could take an ETF for the S&P 500, an ETF for dividend yielding stocks like DVY, and then just set it and forget it. And then you might have a smart ass cousin who's like, ha ha ha, look at me making out. But that only works in one direction. And I'm someone who thinks that my family uses Amazon Prime in our household. And I can think that Amazon is integral to the day-to-day lives of a lot of Americans and still may be overvalued. Because if you look at the numbers, you're like, like X hundred billion, or in some cases even over $1 trillion, does that compute? So it sounds like you're also someone who has adopted index funds in terms of their personal financial planning.
Yeah, and look, I can't give investment advice, and I don't do that in my writings for the journal. And I have certain limitations as a reporter and to prevent conflicts of interest in pretty staid index funds, right? My retirement accounts. I will say that during the past 2 years, in 2020 and 2021, people just had an insatiable appetite for risk, right? They wanted the riskiest stocks. They wanted to trade options. But seriously, they were like, how can I find the next Amazon, right? That's going to loom large over our society. How can I, get into the next Tesla, the next Netflix? So they wanted to trade on margin. That means you're borrowing to kind of magnify your bets. They wanted to trade options. They wanted to trade risky ETFs. And I think in my conversations with individual investors this year, some of them had said, hey, look, I realized that I wasn't going to be successful doing that anymore. It was a lot easier to trade when the market was only going in one direction up. So they said, now I'm kind of just passively investing. I'm dollar cost averaging into these index funds rather than making meme stock bets or these YOLO trades in the market.
Yeah, and I think that's what you won your award for. You might have won multiple awards, but it was like reporting on meme stocks. And
Thank you. Yes.
one advantage to the set it and forget it is it just gives you peace of mind. I mean, what happened to me, I'll share, is that before I decided to run for president, I was like, you know what? I'm going to have zero bandwidth to think about any of this shit. So I'm just going to to do like the most plain vanilla stuff in the universe and just like ignore it for the next couple of years. And it definitely gives you peace of mind where you're not thinking about this stuff at all. Now that kind of runs contrary to the market watching culture, and I have a relative who was essentially day trading while I was ignoring everything. So I mean, there's a spectrum. One of the things I recently rediscovered is that there are now high yield savings accounts that are paying 3.75%. I was like, wow, I've not seen those in years. Like we're back to that now.
Yeah, and I was talking to an executive of a big brokerage, and he was telling me instead of some of those single stock bets, what he's seeing interest in is people looking to what's the yield on this money market fund? What's the yield on this savings account? How can I get yield and the money sitting there in the safest possible thing? And that's a big shift from what we saw. And to your point about set it and forget it, I think one thing that isn't talked about enough is just the emotional roller
Yeah,
coaster that
agree.
it is for a lot of day traders. They have sleepless nights wondering
Yeah.
about their Robinhood accounts, seeing it fall further after they thought they were buying the dip. And that's one thing I heard about a lot last year, where people initially, when they saw stocks fall, they were like, "Oh, I'm buying Nvidia on a discount. I'm buying Tesla on a discount." Guess what happens after that? It keeps falling, which is really, really painful when you're kind of all in the market. So I've heard about a lot of anguish out there over the past year.
Yeah, so those are two very important ideas. Number one, there are psychic costs to being so focused on the market. And number two, there's an aphorism, try not to catch a falling knife, where you see something dropping and you're like, ooh, discount. And then, it can keep
Exactly.
going down. This podcast is sponsored by Helix Sleep. I've always been into sleep as one of the best ways you can invest in your own health. And the way you can sleep better is by getting a new mattress from Helix Sleep. Just take a personalized quiz at helixsleep.com and they will send you a mattress out of their 14 individual mattress types that will give you the sleep of your life. And if you don't like it, you can return it risk-free for up to 100 nights. I know, it's bananas. Helix has been awarded the #1 mattress pick by GQ, Wired, and my kids who seek it out. It's their favorite mattress in the house, and there are some mattresses that, frankly, I spent more money on than the Helix mattress. Helix is offering up to $350 off. That's a bigger amount than ever. All mattress orders and 2 free pillows for our listeners. Go to helixsleep.com/yang. This is their best offer yet, and it won't last long. With Helix, better sleep starts now. You also mentioned Tesla stock, which has been one of the biggest stories. It's had a very rough period, and I think that in addition to a recent report where they fell short of delivery expectations, but the big story is that Elon Musk's attention has been on Twitter, and also that there have been a bunch of people very publicly saying, you know what, I don't want to buy a Tesla now because I'm not as enamored with this version of Elon's persona. And Tesla had, I think, a very clean, futuristic, green energy vibe, where people felt like they were extraordinarily progressive buying a Tesla. And I think that's been a bigger part of the stock story than really even like the more recent delivery numbers.
Yeah, and I think the thing that looms large over all of that is that the 10-year treasury yield, which is like the benchmark for so many things across global markets, is now trading closer to 3.54%.
Yep,
Some of its
that's risk-free
highest
money
levels.
theoretically. Yeah.
Exactly, right. So the math that every single investor does is, what can I get from the risk-free rate versus putting my money into something like Tesla or the broader stock market? And that calculation has completely changed this year. I will say Tesla was really the poster child for some of the euphoria that swept markets in 2020, 2021. People were trading options on Tesla, borrowing on margin to trade Tesla. And what we're seeing right now is just one of like the fastest drops in market value of a major US corporation in history. So it's really, really mind-boggling to watch how Elon's attention has shifted, how that community has evolved. One really interesting thing is that individual investors have actually been sticking with Tesla. They are still buying Tesla in huge amounts. So they have a lot of conviction in the stock. And I think it tells you that, Elon's fan base is still there. Tesla's fan base is still there. But also some of these habits that we learned, that investors learned, like my cousin over the past decade of buying tech stocks, buying growth stocks, those old habits really die hard.
So Gunjan, we're talking about how it's not wise to try and stock pick, but you know who seem to be excellent stock pickers are members of Congress. And one of the things that strikes me as common sense is that lawmakers should just be essentially forced to just buy index funds and set it and forget it, and then when they leave office, they can resume. I think most Americans would agree with that. What do you think?
Yeah, I mean, it certainly does seem like a big conflict of interest, and I'm surprised that they are able to do that. I'm going to plug some of the journal's excellent reporting on the conflicts of interests and trades by judges, by people who work at the government, as well as those in Congress, because it's been really eye-popping for me to see that people across the government can kind of stock pick and stuff like that.
I mean, I've been in some of these rooms, and I got to tell you, I can see very easily how it would happen, where you're a legislator or a very senior official, and you're just around all these senior business people all the time, and they're your friends, they're your supporters, and then if they say to you, like, hey, there's this thing going on, and there's no rule against you taking advantage of it, then it'd be very, very natural for you to pull a trigger and feel smart. And then everyone's trying to do you favors anyway. It's setting people up to, unfortunately, trade on information that the public's never going to have.
It is. What would be interesting, though, is taking a look at or doing some sort of analysis on whether all these people who do trade on such information, whether it's judges or people in the government or people in Congress, do they manage to outperform the S&P 500? Like, I think it's
Oh yeah,
that hard.
they do. They do.
You think they do?
Oh yeah, because I've seen the numbers about the proportion of members of Congress who are millionaires, which by the way now is like well over 50% of them are millionaires.
Wow.
But that was not true when they all showed up. And so you think about it and say, wait a minute, you're getting paid $174,000 a year, which is a fine salary, but you have to maintain a couple of residences. How did you enter a non-millionaire and then emerge a millionaire like 8, 10, 12 years later? It's because their stock market returns are phenomenal. If someone, but I would love to see the Wall Street Journal do a story on this to the extent that the information is publicly available, because I'm very confident that they would be whipping all of us.
I just think it's just so hard to beat the index and to beat passive investments. So that's why I bring it up, and that goes back to the risks that we were talking about.
Oh, I'm very confident that members of Congress are doing what the rest of us cannot, which is beat index market returns on the regular. We all want to get a little bit more for our money nowadays, and one way to do that is to use ExpressVPN to access content you can't get in the US. Let's say you're a Netflix subscriber. All it takes is one tap of a button to change your location so you can control which country Netflix switches to. I've used this when I wanted to watch Vikings, which is a great show, by the way, because it wasn't available in the US, but it was in another country. There are now over 90 countries to choose from, and ExpressVPN works on multiple streaming devices and services, not just Netflix. So stop paying full price for streaming services and only getting access to a fraction of their content. Get your money's worth at expressvpn.com/yang. Don't forget to use my link so you can get 3 extra months of ExpressVPN free. That's expressvpn.com/yang. expressvpn.com/yang. Netflix and other streaming services anywhere in the world. I was just in Asia, and China's gone from zero COVID to like everything's open in breakneck speed. I have family members who are in Asia who frankly got COVID pretty much immediately
Oh,
because
wow.
I mean, they were fine. They're fine. They were
Okay.
young. They're, young parents in our age. I mean, it was stressful, but their symptoms were fine. One of the questions I've wondered about is how much of the world's supply chain is going to be impacted by China's opening up. So there was some optimism when they first announced they're opening up. The markets went up because they were like, "Ooh, good," and like no more of the zero
Yep.
COVID stuff. But then people started actually getting COVID and showing up in hospitals and the like. The estimates of death in China, they start at something like 1.5 million and go up from there. China is going to report numbers differently in a way that, frankly, is going to end up undercounting the impact in a very significant way. But for those folks who are looking at the markets, are you seeing or hearing that the supply chain is going to have problems because of China's reopening?
Well, so far, I think you're right, is that we've seen a lot of the optimism in the market reflected, right? We've seen international stocks actually outperform to start the year over the past 30 days by an incredibly wide margin after really lagging behind the US for a while. And the surge in China stocks certainly plays a role. It's tough to say right now. And I think this is really one of the biggest wild cards for investors, right? Right now, a lot of investors are hoping that supply chain issues are kind of a thing of the past. You're seeing
Yeah.
a lot of measures show that supply chain pressures, there aren't as many ships at the Los Angeles port waiting to unload anymore. I feel like a lot of investors I'm hearing from are saying we're hoping those issues have peaked. We're hoping inflation has peaked and that the CPI figures will show that inflation is declining. That being said, that's the one big wild card for markets, and it's one that no one has gotten right. The Fed did not get it right in 2022. Most investors did not get it right in 2022. Not one person I was talking to at the start of last year was saying they thought we'd end the year with interest rates at the highest level since 2007 and inflation as high as we ended the year. So I'm reluctant to even, forecast or say what could happen there because I just don't think anyone has gotten it right. And it's kind of the biggest risk to markets right now that inflation doesn't go down and that these supply chain pressures don't stay down.
Yeah. If China can't manufacture and ship things like iPhones or all of the things that are built there, then inflation will end up staying persistently high. And then the Fed, to your point, isn't going to lower. I mean, they're already talking about not lowering rates this year. The question is whether rates go higher. So one of the reasons why I am negative on both the market and the economy is because my friends who are fund managers say that the high interest rates will have an impact that has not truly been felt just yet. And you referenced it earlier with the fact that now treasuries are paying 3.5%. So you have risk-free returns that are all of a sudden more appealing, which will depress stock market valuations because they're looking up saying, wait a minute, you have to compensate me for taking this risk, where before you felt like they didn't have to necessarily.
Right.
And my friend said that there are a significant number of actors in the market that were essentially reliant upon low interest rates and cheap money to have their businesses make sense. and now if they, are paying higher borrowing costs, their businesses don't make sense. So that's going to be an ongoing problem. The similar dynamic is in the real estate market, where mortgage rates are now 6, 7, 8%. which is much higher than they were. Gosh, what were they were like less than half that not that long ago.
Yeah.
And so if you're looking at buying a home now, all of a sudden your borrowing costs are much higher, but the prices haven't changed. The sellers are not like, oh, interest rates are higher, I guess I'll bring the price down. Instead, the prices are staying relatively fixed. So what my friend in real estate is saying is that just deals aren't happening. You just have like these the buyer and the seller looking across this gap at each other, and so the volume keeps falling. So how does that play out? I mean, in my mind, logically, prices have to come down because at some point, if you need to sell, you need to sell, and there are different people who are in that position. So those are some of the massive adjustments I think need to be made. Is that a lot of companies need to try and adjust to a higher interest rate environment, which some of them won't be able to do. And then the real estate market has to price correct.
Totally. And that goes back to what we were talking about in terms of tech, right? Take Meta platforms right now. They are hoping to make these huge investments in their business, these huge CapEx investments. And I think years ago, investors would have said, sure, spend a ton of money on that. We
What
think
a
you'll pay out
fiasco
over the
that has
long
turned
term.
out to be. I mean, that's been a disaster.
Huge flop. And part of it is just that these huge companies, these tech and growth companies, just don't have the leeway that they did from investors.
They can do
Companies
no
like
wrong for a
Snap.
long time. It's like your geniuses do whatever. We'll just pile in. Money's no object,
Exactly.
et
And
cetera.
that was fine when interest rates were zero and for a lot of the past decade, but now that they're not anymore, the cost of capital has soared. It's more expensive to borrow. The valuation game has changed. So a lot of investors are saying, we don't think you're worth what you were worth a year ago. So that changes the game for these tech executives.
You talk about Meta and the metaverse. When I'm seeing these TV commercials advertising Meta and the Oculus headset and virtual reality, trying to get people to buy it for the holidays or whatnot, and I thought to myself, wow, I don't think this is going to work. Like, I don't think that tons of people are going to buy this thing. and the folks who log into the metaverse have been pretty consistently disappointed, where that they've logged off and said that this is a wreck. So Meta has lost something like 600 billion in market cap or whatnot. They're laying folks off. I mean, that's certainly another one of the biggest stories, and it's to me a sign of like a single decision-making point where Mark Zuckerberg has controlling ownership of Meta. And so he's like, hey, guys, metaverse, future, let's go, hundreds of billions of dollars. And no one's around to be like, hey, Mark, no one wants to do this.
Yeah. Yeah. It's very 2010s, I guess, where these tech companies just became more and more powerful and they could invest in these moonshot projects. And investors said, sure, here, take our money. And they became trillion-dollar companies. And we've seen that completely fall flat over the past year. And I think it'll be fascinating to see how that plays out in 2023. Do the market values of these tech companies shrink even more? And going back to what you were saying about interest rates and mortgages, a lot of that depends on what the Fed does.
Yeah,
That
a
impacts the
lot depends on what the
valuation.
Feds do. Yeah, for sure.
Yeah, it depends on how much higher they raise interest rates, and that will impact, borrowing costs, housing affordability, as well as valuations of companies like Apple and Tesla and Amazon. And we just have, there's just so much uncertainty about this thing right now that impacts every corner of financial markets. And one really interesting dynamic is that there's almost this like game of chicken between Wall Street and the Fed right now, because the Fed is saying we're going to raise interest rates to the 5% range, and we're going to keep them there until the end of 2023. The market, various like interest rate derivatives markets and swaps markets, showed that investors are betting that they're going to start cutting rates way
Wow.
before that.
Even though they've said we are not cutting rates.
They've said that so many times,
Yeah.
and still you have the market pricing in, we don't think the Fed is going to do that. So it's really a fascinating dynamic. And I think one of the biggest questions for markets and the economy in 2023 is who's right? Is it Wall Street? Is it the Fed? And how high do they raise interest rates? And as we kind of discussed at the top of the call, do their interest rate increases tip the economy into a recession, which is everyone's fear right now.
So is Wall Street pricing in no increases, or is it pricing in the interest rate actually getting cut?
So they're pricing in increases for the next few months before the Fed starts cutting toward the end of the year. And that reflects some of those recession fears that we were talking about. Because why would the Fed cut rates? They would cut rates because their policies are rippling through the market, right? People are unable to afford maybe homes, or they pull back on spending because things get so expensive, and maybe that pushes us into a downturn. And then they would have to cut rates. So it's a very nuanced perspective, but that is indeed what the street is pricing in right now.
Well, that's fascinating. I mean, my friends who are in the business said something to me around it's going to get worse before it gets better, and that they think that the opportunities are going to come after Q1 and Q2. They think Q3, Q4, which it sounds like it's somewhat consistent with what you're saying that the market is projecting. So the new Congress got off to a rocky start where Republicans couldn't figure out their speaker situation. It got resolved with Kevin McCarthy in the 15th try. I didn't notice any market response where, I feel like DC's dysfunction is getting worse, and a lot of Americans are looking up saying, whoa, this crew doesn't seem to have its act together. And the legislative environment is really, really cloudy, given that you have to get Republican House majority on board with something that a Democratic Senate majority is on board with. And what does that overlap look like? Minimal at best in my mind. Is there a sense that legislative dysfunction is already kind of priced in, where people just are shrugging and saying, sure, DC is not going to do anything for the next 2 years?
It's kind of sad, but I feel like in what I hear from investors, see from analysts and stuff, I do think some level of dysfunction is priced in, but not a whole lot of investors. And in my phone calls lately have been even bringing up what's going on in Washington. I feel like the focus is so unilaterally on the Fed and what they're going to do. It's just by far
okay, that's good to know. It's just Fed.
It kind of is. And inflation.
Yeah.
Because we've seen dysfunction in Wall Street before, right? We haven't seen interest rates this high before. We haven't seen inflation this high, at least since the 1970s. So we're in uncharted territory there for even a lot of investors who haven't lived through kind of a macro environment like this. Whereas I feel like from time to time we do see, stalemates in Washington crop up.
Well, the biggest historical echo of this, you'd have to go back to the 70s when inflation was this dire. And one interview I had on the podcast was with a guy named David Rubenstein, who founded Carlyle. And he worked in the Carter administration in the 70s when inflation was, I think it might have crept up to the high single digits, even double digits. And then Paul Volcker, the Fed chair at the time, had to raise interest rates to a point where it caused a significant recession. Even I think it was called stagflation, because you had negative growth and persistent inflation, and it got Reagan in 4 years later. Jimmy Carter wasn't able to get his way out. And so David Rubenstein joked with me on the podcast. He said, well, no one wants me back in politics because last time I was there, you had 10% inflation. That he was joking because he's obviously, now a very successful investor and the rest of it. But you're right. We haven't seen anything like this since then. And that's, that's even before my memory. I was born in the 70s, so as a 4 or 5 year old, I don't remember what's going on. But you must talk to some graybeards who remember that.
Yeah, I think that stagflation scenario. I do think some of those fears about that worst case, high inflation, low growth, stagflationary environment, I think those have eased as we've seen inflation come down a little bit. But that is literally a disaster situation, right? Where that would mean the Fed would have to raise rates even more. But again, it's all such a wild card. I'm not sure if you heard Jamie Dimon this week say the Fed has said they're going to raise rates to around 5%. I think it could maybe be 6%. What does that mean for the stock market? We really don't know.
Jamie's right. I mean, that would be. tectonic. So I've spent some time with Jamie Dimon, and a number of years ago he came out and said that the American economy is not working for the average American, and we should come up with like a Marshall Plan to rebuild the economy, which I appreciated from Jamie. He's been one of the more dour alarm ringers recently. and Ray Dalio was also on the podcast, and he said something similar about the American economy not working for the average American. If Jamie's right, I mean, we'd be in for a very, very rough go, because it would be the only reason interest rates would continue to go up like that is if inflation just is very, very persistent and stubborn. And you can plausibly say, hey, if you have a supply chain shock because of COVID in China, like that could happen. There are different wildcard scenarios, to your point, though. Right now, more optimism is creeping in because we've gotten a couple of good data reports lately.
Totally. But I do want to, I think you bring up a really interesting point about, is the American economy working for the average American and for the average worker? And I think one of the most fascinating dynamics playing out right now is during COVID, the inequality was just on full display, right? We saw the stock market soar to new heights. White collar workers were sitting at home on their laptops on Zoom, and you had blue collar workers out there braving COVID, right? And it seemed very unfair. And I think inequality was really just on stark display at that time. During the recovery after that brief recession that we saw in 2020, I do think what we've been seeing in the jobs figures and in some of the wages figures is just unbelievable demand for blue collar workers. And I think they have a lot more leverage than they did, even a few years back. And I think in the past downturns, they kind of faced the brunt of the layoffs. And we at the Journal recently reported, is that changing? Is that dynamic evolving? Because I think what we're seeing is that these big tech companies are laying off workers where there's still so much demand for some of those blue collar jobs. So I think that's a really important thing to watch in the economy in 2023 is how does that evolve?
So you and I have been talking a lot about the markets, which people use as a proxy for the economy, but the top 20% of Americans own 80% plus of stock market wealth, and the bottom 48% of Americans own zero stock market wealth. So you have the market on one hand, and then you have the economy on the other. Now, of course, what happens in the market affects, quote unquote, the real economy because of people going out and spending money and optimism and a bunch of other things. We said before that crypto hasn't really affected the market. Even as the market had a relative downturn, the real economy has stayed more or less intact. What do you think about the market's relationship with, quote unquote, the real economy out there? Are we seeing an environment, which you just suggested, which is that, look, the average American can actually be on the upswing in terms of wages and the rest of it, even if the markets don't fare well?
The thing I would start with is that the stock market is absolutely not the economy, and that has never been clear, right? During COVID, businesses around the country were shut down. We were all sitting at home, and the stock market was soaring. And thanks to those big tech companies that really loom large over the S&P 500 index. And now unemployment is super low. Wages have been ticking higher.
The one thing I do want to say on the unemployment being low, the labor market has shrunk. Since COVID. So there are a lot of people that went home and just have stayed home. The number I saw was something like 2.6 million. And eventually you would think that they would have to come back into the workforce, though if you spend time out of the workforce, unfortunately, sometimes you kind of stay out of the workforce, like you can atrophy in various ways. So you're right. The headline unemployment number is like 3.5%. It's like very, very low. But the labor force participation rate is staying also stubbornly low, and we're all hoping that more people re-enter the workforce, but it hasn't happened yet.
So I think there are some signs that it's happening, and we at the Journal recently cited some research from the St. Louis Fed, and this is so interesting. I just want to read it to you.
Please, yeah, I love it.
It showed that the St. Louis Fed estimates that falling asset prices may have led nearly 400,000 American workers aged 51 and up to rejoin the workforce between January and October from last year. So maybe there is an increasing relationship, right, between the stock market and the economy, where I think so many people saw their portfolios kind of swell during the pandemic, and maybe some
Interesting.
retirees who would have stayed at home decided to re-enter because stock prices were falling. And it'll be interesting to see how that progresses in 2023, because to your point, yeah, the labor force participation rate, people are sitting on the sidelines. Do they keep entering because of what's going on with the stock market?
Gunjan, that's a very, very dark uh, snapshot, because what you said was essentially that there are, 51 to 54-year-olds who've seen their savings decrease and their portfolios diminish, and they were like, "Oh no, I better get out of work. Like I thought I might be able to sit back and retire." I mean, like
It's incredibly
that's
dark.
not the that's not the spur
It's
you
very
want to
dark.
get someone out there like that they feel like they're going to be destitute.
No, and of course, it's actually for retirees. It was just a terrible, terrible year. Well, I guess this data shows they re-entered between January and October last year. Yes, and that was one of the worst years on record for this traditional 60-40 portfolio of 60% stocks and 40% bonds. So it was just an awful year to kind of decide to retire. And you're right, it is very sad if they had to re-enter, although this data was for people aged 51 and up. But also there were like, young traders who thought that they, were could trade stocks or sit at
Yeah,
home and
I know
invest,
people
and
like that.
maybe
I know
not.
people like that.
Yeah. I
Yeah.
think we've all heard some of those anecdotes. So you're right, it is very sad if, would-be retirees would have to re-enter the workforce. But I guess my point is that these rising asset prices seem to have played some role in the labor force participation rate.
That's fascinating, and I know people who are governors of the St. Louis Fed, so I'm sure that they are excited that you're quoting their data. They're like very proud of their data. I also cite the
It's
St.
good
Louis Fed.
data.
Yeah, they have some of the best data around. It's true. I also do have a couple of college savings accounts or retirement accounts that resemble that 60-40 allocation, where when I made it for my child, I was like, sure. And then I haven't looked at it in a long time, and I looked at it recently. I was like, wow, like that's lower.
Yeah.
Like you look at it. So I can imagine, unfortunately, Americans looking at their accounts, like snapping to attention, saying like, what? Like this thing has gone down, 15, 18, 20, 22% or whatever it is. And then it changing their decision making.
Yeah, and how does it impact, your spending in the real economy? Yeah, your job choices and all of that. So you sound like one of those people who only opens a retirement account when it's going up, when the stock market is going up.
I'm pretty much a funny duddy. So like that dollar cost averaging, the set it and forget it, the just like look, contribute that much and don't think about it. That's been my MO over this
Okay.
last period of time. When I say period of time, I mean it's been a number of years now. So, do I have a lot of friends who are, like doing much more aggressive, risky types of investing? Like heck yes, like I've got a lot. I've got a lot of them. But I'm pretty boring in part because
Okay.
like my energies have been focused in this other direction. And I just did not want to have my bandwidth sucked up by monitoring things.
Yeah, and things have been so volatile, so it would take a fair bit of monitoring.
So you have a bird's eye view of the markets, the economy. You have sources all over Wall Street and Main Street. I'm going to give my kind of like basic message and guidance, which is one of the reasons I wanted to have you in, and then I'd like you to sort of like project out as well. I see this as a transition year and probably something of a painful transition year. I personally think that people should look for conservative bets and risk-free returns. I mean, again, right now you probably have money sitting in an account that pays you less than half of 1% because like I mean I do. I'll just speak for myself. And then I looked up and was like, wait a minute, there are accounts now paying 3.5, anyways, 5%. Like I should probably get on that. This would be like a very good year to consolidate, to maybe a bit more conservative in your decision making, and to be in a position where if things do have some pullbacks, that you're not losing sleep over it. That's my personal orientation for certainly the first half of this year. I think that some of these high interest savings accounts are a good idea. I think that index funds are always a good idea, particularly those that pay dividends, which are a really great way to balance out your returns and lower volatility. And, I just want people to stay safe out there. I think I project an air of entrepreneurship and optimism, which I do have. I mean, it's genuine. But I also have a sense as to the way that people can live with peace of mind and prepare for the future in a way that's not going to leave them in the lurch.
It's funny that you brought up these high yield savings accounts, because it's almost like inflation protected bonds became the new meme stocks over the past year, with the U.S. Treasury just seeing unprecedented activity there. I think, and again, I'm not here to give investment advice or or anything like that, but I do think that a lot of the shams that kind of cropped up over the past few years have unraveled, right? With FTX, SPACs, not necessarily a sham, but this thing that seemed to skyrocket, and just the things that kind of seemed too good to be true. It turns out they really were too good to be true, and it's really hard to get eye-popping returns out there. I think one thing that strikes me is that even for professional investors, economists, forecasters, it's really, really, really hard to forecast and time a recession correctly. So I think that's something all investors should really keep in mind, is that even some of the best Wall Street strategists, economists, if you keep hearing about a recession, sure, maybe we'll fall into a recession in the first half of this year, but maybe we won't. No one got 2022 right. So I think it's important to take all of these forecasts with a grain of salt, because it's really hard to time the market and kind of position perfectly for these things.
I agree with that. I think that economists have gotten something like 0 of the last 10 recession calls right. And what I said before is like trying to outsmart everyone is not a great approach. I mean, that's true for any of these forecasting calls too. You just want to do something that you're comfortable with. And it really infuriates me when political figures either talk up the market or talk down the market or take credit for the market, because 9 times out of 10 they had nothing to do with it.
Yeah, I mean, historically, stocks have gone up through many presidential and political cycles, right? And the economy does seem to have been on an upswing since COVID, but the stock market isn't reflecting that right now.
Gunjan, thank you for being a voice of reason and sanity and perspective. How can people keep up with you and your work? You are on Twitter, which is one way people can follow you. Are there other things people can do?
Thank you for asking. I am on Twitter. I tweet a decent amount about markets and the economy at GunjanJS. And I'm on Instagram at GunjanSB.
Well, really, I'm going to be excited about watching your commentary and progress. Congratulations on a phenomenal start to your career. I'm going to guest star just because you seem you seem relatively young. And the next time there's like a massive implosion or catastrophe or something like that, we'll have to have you back.
Happy to come back. This has been so fun chatting with you. Thank you, Andrew.
Thank you, Gunjan.